Hi, everybody. This is Peter Schiff. It is Wednesday, September 17th, 2014. Today, the Federal Reserve Open Market Committee concluded its two-day meeting with its announcement and the press conference that followed, where Janet Yellen fielded some questions from the press. This was a highly anticipated meeting, as they all have been recently. The Fed did not really surprise anybody. It continued its taper. It reduced its bond buying by another $10 billion. I think it took $5 billion out of the mortgage-backed securities and $5 billion out of treasuries. So instead of buying $25 billion a month, down from the original $85 billion, the Fed going forward next month will be just buying $15 billion. And I think, according to Janet Yellen, the next time they meet, they will wind it down completely and they will no longer be officially doing QE. Of course, unofficially, they're still going to be buying U.S. government securities. Janet Yellen did reiterate her intention to reinvest any interest that the Fed earns on its enormous portfolio by buying additional treasuries, and any treasuries that it owns, if they mature, they will roll them over. So they're not going to ask the government for their money. They're simply going to reloan the U.S. Treasury any money so that they can fund the maturing debt. So that's still a lot of bond buying, but it's not as much as they were buying in the past. Now, one thing that everybody has been looking at was the language. And one key term was left in, and this was the considerable period. Janet Yellen and the Fed have said that there will be a considerable period of time that will transpire between the end of QE and the first rate hike. Now, several people asked Janet Yellen if she could define considerable period. Remember, she tried to do it once, and she said maybe 6 months, and then she backtracked. And so now she was asked again if she can define that term. And again, this time she said, no, I don't really know what it means, and nobody really knows what it means. It just gives us a lot of latitude to do what we want to do, whatever that might be. Now, in my mind, what the Fed really means by considerable period is indefinitely or forever, because I don't think the Fed can raise interest rates. In fact, I don't even think that they could end QE without precipitating a recession, and I think they've already set those balls in motion, and I think the economy is careening towards recession right now. The Fed just hasn't figured that out yet. But the Fed certainly doesn't want to help push it over the edge by raising rates. So it has to stall, so it comes up with this considerable period. I mean, if the Fed doesn't know what considerable period means, if Janet Yellen claims that she has no idea what that means, why even insert the words? Why include it in your official communique? I mean, why write those words? I mean, obviously, they're crafting this word by word. They know that the market is dissecting every word that's there, looking for any kind of changes. If they don't even know what it means, why include it? I think the reason it's there is because they want cover. They want to talk about raising rates, but not actually do them. So they need to buy some time. And by inserting the words a considerable period without defining them and leaving it open-ended, I mean, what's a considerable period? Is 1 year, 2 years, 5 years? I mean, what's considerable, right? I guess, it all depends on your perspective. It could be anything. So I think the Fed is deliberately, being very vague in what it's saying because it wants to have its cake and eat it too. It wants to pretend it can raise rates without actually raising them. To me, the Fed is making the same mistake now as Greenspan made. If you remember, when Greenspan brought interest rates down to 1% and left them there for about 2 years or however long he left them there, when he started to raise them, why did he raise them very slowly? Right? He raised them by 1/4 of a point every time they met. Well, I think Greenspan understood how the housing market and the economy was dependent on this cheap money. And he was afraid of just going cold turkey, right? Taking the punch bowl away too quickly. And he thought, well, if we just ease our way out of these low interest rates, the market will have time to prepare and everything will be okay. Well, that was a very bad bet because we lost big time on that bet, because not only wasn't the market capable of handling the transition from 1% rates to 5% rates. But the fact that the Fed waited so long to raise them and did it so slowly, that just compounded the problem, because that allowed more air to blow into the bubble. So the Fed was afraid of raising rates too quickly because of how addicted we were to cheap rates, and the Fed was afraid of what might happen if there was an abrupt increase, and so they raised rates slowly. The result was the bubble that they were worried about pricking got a lot bigger. And so when it eventually did pop, it was a lot worse. There was a lot more damage that was done. It would have been better had Greenspan raised rates much quicker and precipitated the crisis sooner, because it would have been a smaller crisis. Of course, it would have been better had they never made the mistake of lowering rates to 1% in the first place, but that's a different story. But where is Janet Yellen today? This is the process that Ben Bernanke started. See, Ben Bernanke got the economy addicted to even cheaper money than Greenspan. And then after he got the economy addicted to 0% rates, then he got it addicted to QE. And then before he left town, Ben Bernanke realized that, we can't take away QE abruptly, right? Because the economy is dependent on it. The financial markets are dependent on it. So let's taper it off, right? Let's just remove the QE very slowly, just the way Alan Greenspan slowly removed the artificially low interest rates. But remember, the whole time, interest rates are still at zero. So they're just tapering off the QE, right? They're not touching interest rates. But I think that it doesn't matter, how slowly you apply the pin. You still prick the bubble. And just because they removed the QE slowly doesn't mean the bubble that was inflated by that QE isn't going to pop, right? Just because the pin was, was applied slowly doesn't stop the process. So I think just as Greenspan was wrong back then by thinking that raising rates slowly wouldn't be a problem, I think the Fed is also wrong by saying that removing QE slowly won't be a problem. It's going to be a problem. Of course, there is a little bit of a lag, right? The Fed stopped raising interest rates in 2006. We didn't have the crisis until 2008. The last rate hike was in, I think, June of 2006, right? So before the financial crisis. So how much time is going to transpire between the end of QE, which is scheduled to end now in 6 weeks? How much time will transpire between the end of QE and the next crisis, the next recession? See, I don't think there'll be enough time for the Fed to even begin the next set of rate hikes. And see, that is the bigger problem. See, in past business cycles, right, the Federal Reserve will lower interest rates to stimulate the economy. When they get the economy going, they start raising interest rates to keep it from overheating, right? That's your Fed speak. And then at some point, it rolls over back into recession, and they repeat the process. So they lower rates, they raise rates, they lower rates, they raise rates, and that's how they control the economy. But now, the last time we had a recession, right, the Fed dropped interest rates to zero, and they've been there. Interest rates have been at zero since early 2009, 5 years. In fact, it's been 8 years since the Fed raised interest rates. They started cutting rates in 2008, but the last rate hike was in 2006. So for the last 8 years, there's only been one direction for interest rates, and that's been down, or they've been at zero, right? And the average length of a post-World War II recovery, right, the length of time between the end of one recession and the beginning of the next is about 5 years. So we're already overdue for the next cyclical recession, yet interest rates are still at zero. See, what I think has actually happened now is interest rates have to stay at zero. They can never go up. And the only thing that the Fed does is adjust the amount of QE. So when the economy is growing, it does a small amount of QE, or it tapers QE. And then when we have the next recession, they're going to ramp it back up again. So it's just going to be the expansion and contraction of QE, while interest rates have to stay at zero the whole time. Because we're now so broke, we have so much debt that we can't possibly afford interest rates above zero. And so the Fed is going to try to do what it used to do with interest rates with QE. But all this talk now about how soon is the Fed going to start to raise rates and when is the Fed going to raise rates belies the point that they can't. Because not only can't we afford higher rates, I don't even think the economy can sustain itself without the QE. And imagine that. Think about how weak the GDP growth has actually been, right? We've been decelerating because 2013 was below 2012, and 2014 is probably going to be below 2013. But all those years had QE. So if the economy can barely grow with all the QE, what's going to happen when you take it away, right? And again, all this growth is phony. It's not real growth. But in order to have the phony growth, you need the QE. You take the QE away, you take the phony economic growth away, and you are right back in recession. And in fact, when Janet Yellen was asked about her forecasts and maybe why are her forecasts at odds with some of the private sector forecasts, which show rates staying lower longer than what some of the Fed governors believe, Yellen said, well, they have different economic forecasts than we do. Yeah, their economic forecasts are less rosy. Private economists are more pessimistic than the Fed. The Fed is very optimistic, but they're always overly optimistic. History shows that the Fed often overestimates the strength of the U.S. economy. And then afterwards, they have to come back and ratchet down their expectations. And so whatever Janet Yellen and the Fed, whatever they're saying now about how confident they are that they might be able to raise interest rates after some considerable period of time, but we don't know what that means, it's all based on their rosy assessment of the U.S. economy that isn't going to materialize. The economy is going to roll over back to recession before the first rate hike ever comes. And so it's not going to come because now they're going to have to ramp the QE back up. And maybe at that point, people will figure out the box that we're in. If they figure out that it's interest rates at zero forever, and the only question is how much QE does the Fed do, but it can never raise rates, then the bottom drops out of the dollar, which, by the way, rallied today. I think the dollar index hit its highest level since July of last year. Dollar was up across the board against all the world's currencies, major currencies today. Gold down about 12 bucks. Gold now at the lows since early January of this year. So currency traders, metal traders, believing that, yes, the Fed is closer to a rate hike just because they're talking about it. They even started to lay out, Janet Yellen talked about how she's going to raise rates, like when it comes time to raising, how they're going to go about it. Of course, all of that is theoretical because they're not actually committing to raising rates at all. They're simply stating that, well, if the economy does as well as we think, after some considerable period of time, then we're going to raise rates. But we don't really know what a considerable period is. We can't define it for you. But we're going to raise rates at some point, and here's how we're going to do it. And the markets actually take them seriously as if they're really going to follow through with this promise or this threat, depending on how you want to look at it. But again, the Fed has to pretend. They can't say that they can't raise rates. They have to pretend that they can normalize rates. But they can't. We have an abnormal amount of debt. We are addicted on all levels of the U.S. economy, not only the government, but the corporations, the housing market, the banks. Everybody needs interest rates at zero or practically zero. And they need all this QE to sustain these elevated asset prices. I mean, what would happen if sometime between now and the next 6 to 9 months, which maybe is when people are thinking the Fed's going to raise rates, what happens if we have a correction in the stock market? What happens if we get a bear market in stocks? What's the Fed going to do? Because remember, the recovery is based on the wealth effect of a bull market in stocks. Well, if all of a sudden we have a big drop in the stock market, what's the Fed going to do? Are they going to tighten? Hell no. They're going to do more QE. So if the stock market goes down, what about the real estate market? A lot can happen in the next 6 to 9 months. Again, we're long overdue for a cyclical recession. So what's going to happen if the real estate market goes down? Well, the Fed's going to have to do more QE. There are a lot of bad things that can happen, none of which the Fed forecasts. There are no bad things that the Fed has ever forecast. And it's either because they're completely ignorant and they know nothing about economics and they can't see any of these problems, or they're deliberately lying about the problems that they see because they don't want to level with the American people or the financial markets they don't want to admit the problems they see because they're afraid by acknowledging those problems, they might create a panic. So whatever it is, either they're ignorant or they're lying, but either way, they never can forecast any of the negative things that happen. And there's a lot of negative things that could happen between now and the time where theoretically they may be raising rates. Interestingly, Yellen was asked a question about Europe and about the problems they're struggling with, about low inflation and economic growth. And Janet Yellen wished them luck. And she said, we hope that they can get higher inflation and more economic growth in Europe because that would really help America. Yeah, that's the last thing that Janet Yellen needs. If she's trying to sustain this bubble, she needs people to be worried about Europe or Japan because it's that flight capital flowing into the treasury markets, flowing into the dollar that's buying her all this extra time. Believe me, the last thing Yellen wants is a vibrant recovery in Europe that would take money out of treasuries and that would force the ECB to start to raise rates, which is something that the Fed can't do, and would put more pressure on the dollar, more pressure on consumer prices here, more pressure on the U.S. economy. So the best thing we got going for us right now, from the point of view of sustaining this phony recovery, is that other countries are having problems, and people perceive those problems as being greater than ours, even though they're not. And because of those misperceptions, money flows from those economies to ours, propping up our markets and perpetuating the myth that we're doing okay when our problems are actually more severe than the problems in the countries that everybody is fleeing. And also, on inflation, by the way, we got the CPI numbers that came out today. If you believe the government numbers, the core CPI, I think, was 0. And the headline was actually down 0.2. It was one of the lowest numbers of CPI. So now year over year, CPI is just 1.7%. And so now the Fed is probably nervous about that. Oh my God, it's going in the wrong direction. In fact, in their statement, they, instead of saying that inflation is nearing their objective, they changed the language to saying that inflation was below their objective, meaning they have even more leeway not to raise rates because there's not quite enough inflation. Now, they said this, I guess, on a day I read an article that milk prices just hit an all-time record high. I'm not sure how many other prices are hitting record highs today, but most Americans are experiencing an increase in the cost of living that is well in excess of 1.7%. Also, not only did the Fed lay out this phony, methodology under which it's going to raise rates, even though it's not going to do it, Janet Yellen also talked about how she was going to shrink her balance sheet, which again, that's even further into the future, supposedly, than the rate hikes, and how she's going to do it, how she's going to wind down her balance sheet. And she basically said that it would take a while if they just let all the debt mature. But she thought that by the end of the decade, the balance sheet could be reduced in size to something that approached the level pre-crisis, which it's impossible to do that. I mean, the Fed's balance sheet is what, $4.5 trillion, approaching $5 trillion. I mean, to get it back down to $1 trillion, to get rid of $4 trillion in securities in 6 years. What is that? $600-700 billion a year? $800 billion? There's no way the U.S. government could retire all that debt in addition to the annual budget deficits it already has. This is impossible for the Fed to allow all that debt to mature because the government doesn't have the money. An interesting thing, too, with all this bragging, President Obama, hey, we got the budget deficit down, right? It's down to under $600 billion, right? 580 or something was the number. But somebody wrote an article that I read on the internet that correctly pointed out that during the year where President Obama is claiming credit for reducing the budget deficit to what, below $600 billion, the national debt increased by over $1 trillion during that same time period. That means we added over $1 trillion of new debt on top of the debt we already had. Well, if that's the case, how can we claim that the budget deficit is only $600 billion? How did we get that extra $400 billion of debt? Well, the answer is we don't count it, right? It's off budget. You see, what the government does with their budget, it's kind of what they do with the CPI. The core CPI, they decide that they're not going to count certain things so that the number is lower. Well, how do you make the budget deficit lower? You just don't count a lot of the deficit. So what they do is they take a lot of the expenditures and they move them off budget. And therefore, any money they borrow to pay for those off-budget expenditures doesn't count as part of the annual budget deficit. So when they report what the annual deficit is, they don't have to report any of the debt associated with the off-budget expenditures. But the money was still spent, just like the on-budget expenditures, and the debt is just as real. We still have to pay the interest on it, and in theory, we still have to repay the principal. So the debt is still on the books. It's not off the books. So why don't we count it? I mean, if we have $400 billion of off-budget debt in a year, why shouldn't that be counted? You know, I could see the argument if, we had these off-budget expenditures, like they were one-off events. They happen once in a rarity, like, every 10 years or something, there would be some kind of off-budget expense. But if you routinely have enormous off-budget expenses every single year, you got to count them. I mean, because it happens. It's not like some extraordinary event that you couldn't plan for. The government plans for all these off-budget expenditures. And if you're planning for them, they need to be on budget. It's all an accounting myth. But, they claim credit for it, just like they can't claim credit for economic growth that doesn't exist or for inflation that doesn't exist, right? They claim credit for reducing the deficit even though they're not, even though the deficit is growing. So the government still has to sell $1 trillion worth of bonds every year to fund its off-budget and off-budget deficit spending. How are they going to do that and repay the Fed all the money that they claim they're going to get when they allow their bonds to mature? Who is going to buy all these bonds in the private sector when the yields are still next to nothing? Nobody. So again, all this is talk. They're not going to shrink the balance sheet. They can't. They're not going to raise interest rates because they can't. And before this considerable time period comes to an end, we're going to be back in recession, or we're going to be close enough to recession that the Fed feels compelled to take action to stimulate the economy. And how is it going to stimulate the economy? Well, rates are still going to be at zero. The only way to stimulate it is to ramp up the QE that she just tapered back. And how much is she going to have to ramp it up to? I think it's going to be more than the original $85 billion, maybe $100 billion, $150 billion per month. Anyway, a lot more stuff going on this week. If you want to get my take on all of the week's economic, political, and market events, don't forget to listen to my weekly podcast. Of course, you can hear it on this YouTube channel, Schiff Report. We had some problems. We've ironed them out at Schiff Radio, so you should be able to download the most recent podcast as well as the one coming up at Schiff Radio. And it's also now finally up on iTunes. So those of you who go to iTunes for your podcast, you should get the Peter Schiff Show on iTunes. And again, we're trying to get it included in as many platforms as we can so that it's as convenient for you not only to download and listen to my podcast, but to share it with your friends and to make sure as many people as possible hear the truth about the economy, about the Fed, about the dollar, about what's going on in the United States, because they're not going to get the truth from conventional media sources. They need to turn to alternatives like the Peter Schiff Show. Thanks for listening and take care.